Hey there, fellow investors. It's great to see so many enthusiastic faces ready to embark on this financial journey. Welcome to Investment Island, where we explore the exciting world of finance. This island is your gateway to understanding the various facets of investing, from stocks to bonds, and everything in between. Today, we're diving into the often overlooked but incredibly important bond market. Bonds are a crucial part of any well-rounded investment strategy. Yet they don't always get the attention they deserve. Don't worry, it's not as complicated as it sounds. Bonds are essentially loans you give to governments or corporations, and in return they promise to pay you back with interest. Bonds are like the reliable friends of the investment world. They might not be as exciting as stocks, but they offer a level of security and predictability that can be very comforting. They might not offer the same flashy returns as stocks, but they provide stability and predictability. When the stock market is volatile, bonds can help balance your portfolio and reduce risk. Think of them as the anchors of your portfolio, keeping things steady during market storms. Just like an anchored ship can weather a storm, bonds help your investments stay afloat during turbulent times. Ready to learn more about these financial superheroes? Let's get started. We'll explore different types of bonds, how they work, and why they should be a part of your investment strategy. So buckle up and get ready for an exciting adventure on Investment Island. In simplest terms, a bond is a loan you give to a borrower, like a government or a company. You lend them money and they promise to pay you back with interest. Think of it as an IOU with a guaranteed return. The borrower issues a bond with a fixed interest rate and a maturity date. The interest rate is like the rent you charge for lending your money. The maturity date is when you get your initial loan amount back. Just like ice cream, bonds come in different flavors to suit every investor's taste. Each type of bond offers unique characteristics and benefits, catering to various financial goals and risk appetites. Let's check out the most common types and see what makes each one special. Government bonds. Issued by the government, these are considered the safest. They are a popular choice for conservative investors looking for stability. Think U.S. Treasury bonds, backed by the full faith and credit of the United States. These bonds are virtually risk-free, making them a cornerstone in many investment portfolios. Corporate bonds, issued by companies to raise capital. These bonds are a way for businesses to fund new projects, expand operations, or refinance debt. They offer higher potential returns than government bonds, but come with slightly more risk. The creditworthiness of the issuing company plays a significant role in determining the bond's risk level. Municipal bonds issued by states, cities, and local governments to fund public projects. These bonds help finance essential infrastructure like schools, roads, and hospitals. They often come with tax advantages, which is a bonus. Interest earned on many municipal bonds is exempt from federal income tax, and sometimes state and local taxes as well, making them an attractive option for tax-conscious investors. Whether you're looking for safety, higher returns, or tax benefits, there's a bond out there to match your investment strategy. Understanding the different types of bonds can help you make informed decisions and build a balanced portfolio. So next time you're thinking about where to invest, remember the many flavors of bonds and choose the one that best suits your financial taste. Bonds offer several advantages, making them attractive to many investors. Fixed income bonds provide regular interest payments, creating a predictable income stream. This is especially appealing to retirees or those nearing retirement. Diversification bonds are an excellent way to diversify your portfolio. They typically move in the opposite direction of stocks, providing a cushion during market downturns. Preservation of capital bonds are generally less volatile than stocks, offering a safer haven for your money, especially if you have a low-risk tolerance. While bonds offer numerous benefits, it's important to be aware of the risks. Interest rate risk. When interest rates rise, bond prices usually fall. This is because investors can buy newer bonds with higher yields, making existing bonds less attractive. Inflation risk. High inflation can erode the purchasing power of your bond's interest payments and principal repayment. Credit risk. For corporate and municipal bonds, there's a chance the issuer might default on their debt, meaning you might not get your money back. Section 6. Bonds and interest rates. A rocky relationship. Bonds and interest rates have an interesting relationship. They move in opposite directions. When interest rates rise, bond prices fall, and vice versa. Think of it like this. You bought a bond paying 3% interest. If interest rates rise to 4%, your bond with the lower rate becomes less desirable to other investors. To sell it, you'd likely have to lower the price. Section 7. Navigating the bond market. The bond market can seem complex and overwhelming at first glance, but with the right approach, it can be a valuable part of your investment strategy. Don't let the bond market intimidate you. It's all about understanding the basics and taking informed steps. Here are a few tips for navigating this world. First, it's important to educate yourself about the different types of bonds available, such as government bonds, corporate bonds, and municipal bonds. Each type has its own risk and return profile. Start small. You don't need a fortune to invest in bonds. Begin with a modest amount that you are comfortable with. You can start with a small amount and gradually increase your investment over time. This approach allows you to learn and adjust your strategy without taking on too much risk initially. Consider bond funds. Bond funds pool money from multiple investors to buy a diversified portfolio of bonds. This diversification helps to spread risk and can provide more stable returns. This is an excellent way to diversify with a smaller investment. Bond funds are managed by professionals who have the expertise to select a mix of bonds that align with the fund's objectives. Consult a financial advisor. If you're unsure about bond investing, don't hesitate to seek guidance from a financial advisor. They can provide personalized advice based on your financial goals, risk tolerance, and investment horizon. They can help you create a bond strategy tailored to your specific needs and risk tolerance. Additionally, a financial advisor can keep you informed about market trends and help you make adjustments to your portfolio as needed. Remember, investing in bonds is a long-term strategy. Patience and consistency are key. By starting small, considering bond funds and consulting with a financial advisor, you can navigate the bond market with confidence and build a solid foundation for your financial future. With these tips in mind, you're well on your way to becoming a savvy bond investor. Happy investing! Section 8. Bonds, a piece of your portfolio puzzle. So, are bonds right for you? The answer depends on your individual financial goals, risk tolerance, and investment timeline. If you're looking for a stable investment with predictable income, bonds can be a great addition to your portfolio. They're especially beneficial for those closer to retirement or seeking to preserve capital. Remember, diversification is key. Don't put all your eggs in one basket. Section 9. Keep learning. That's a wrap on our bond market adventure. Hopefully you now have a better understanding of how bonds work and why they're an essential part of a well-rounded investment strategy. Remember, knowledge is power. Keep learning, stay informed, and make smart investment decisions. And hey, if you found this guide helpful, don't forget to like and subscribe for more exciting financial adventures on Investment Island.